Yeah, thank you, Robbie, and good morning to everybody on November the 5th. Just again, I'm echoing what Robbie's saying too, thanking you all for allowing me the opportunity in Virginia Farm Bureau, the opportunity to partner with y'all and to participate in some of these Ag Today programs on Thursday mornings. I think y'all are having a lot of success with them in Farm Bureau, and I'm very glad to be associated with them. I'm always grateful too to thank any Farm Bureau members that are out there that are listening. We appreciate all the work that y'all do advocating for agriculture at the county level. We ended our membership year, Virginia Farm Bureau Federation did, at the end of October, and we did reach our quota this year with just over 129,000 members for the next year. That's exciting for us, and to see our membership grow each year. And that represents, in that 129,000 plus members, we have 35,000 producer members, and just a privilege to be a part of you all's organization and to see the work that y'all get done every year. We're in our 40, let's see here, our 48th year at Farm Bureau, having a grain marketing service. And it was designed and set up to assist the members in gathering information, assist them in having access to trucks, access to more destinations for their production, and access to a hedge account so that they could buy and sell futures and buy and sell options directly. And we're thankful that the leadership here at Farm Bureau still has this program in place. I guess I'm going to go ahead and move right into some basics of grain marketing. And the first thing I would say is we have to start off thinking about the term cash price. Everything is all going to come back to cash price. And if you divide that into three parts, we know that part of that cash price is made up of the Chicago futures. That's the basis for every bushel that's going to change hands between a buyer and a seller, is that Chicago futures price. We know that the futures are traded by commercial entities who we sell to, and we know they are also traded by speculators who are literally trying to predict the future price of a commodity a specific month at a specific location. For corn, they're licensed warehouses on the Illinois River. That's what that future price represents. What is a bushel of corn worth in December on the Illinois River? And for soybeans, licensed warehouses along the Mississippi River, for instance, is what they're trying to predict the price of. What is a bushel of beans worth in November 2020 on the Mississippi River? So number one in your cash price is the futures component. Number two is local basis. And remember, local basis is the difference, whether positive or negative, above or below the futures contract that the local buyer is willing to pay. Very important, very, very important. And that is set locally, and it can change very regularly, or it can stay the same for a long time, just depending on the time of year and depending on local influences. And then the third is freight. We always have to remember that it costs us to get our production to a destination. I know that is a strange thing. All of y'all would echo about commodity agriculture is that the people who produce it are always responsible for the freight on getting it where it needs to go. We're not like a car dealer that you can buy the car and you can look at the window sticker and you can see that $750 or whatever the destination charge is. We don't theoretically charge the buyer. We absorb that cost. So cash price is a function of futures, basis, and freight, and we're always working those together. When it comes to marketing, the first and most important thing we always have to talk about is cost of production. And all of you listening are economists. Every one of you in some way, shape, or form in your work, at your home. Some of you are formally trained as an economist as well. So we've got a lot of experience listening here. y'all know the value of knowing what the cost of production is. The interesting thing about agriculture and production agriculture, and this is true in many small businesses as well, but in production agriculture, everybody's cost of production is different. That's not right or wrong, but the important factor is, in order to market your production successfully, you have to know what it costs to do that. And then obviously, when we start to think about the targets that we need, our cost of production kind of in a formula with our yield, and then we figure out what we need to break even, and then we figure out what margin we want above that. That is as simple as it gets on figuring out where we want to start setting our targets. So cost of production is different for everybody, and it has to be known. Your marketing, really, without knowing what you're able to do from a profit perspective, if you don't know that. So saying all of that, the next thing you need to do is write everything down. I know that sounds elementary, simple, and it is. There are lots of templates available from multiple land-grant universities. There are lots of templates to write marketing plans that are available through private firms that are free online. There's lots of them online that you can buy. I encourage everybody to take a look at some of those templates, but you really just need a blank sheet of paper and a pen to write your own marketing plan up. And the whole point of that is, like a lot of things in life, it's very true in marketing, we have to be proactive. We can't not do something, especially in the area of marketing. A producer would never not be proactive in raising his or her crop. They're going to take the soil samples, calibrate the equipment, do things in a timely manner, protect it, take care of it, feed it. All those things are proactive. All we have to do is transfer that to the marketing side. And by writing that plan down on a sheet of paper is very important and a great first step. Just like with anything, you need offensive strategies that are going to allow you to keep upside potential. That's just a simple way of saying you're going to have bushels or production that you haven't sold or priced that you can participate in a rally if it comes. And then you've got defensive strategies in your marketing plan that you are selling your production. You grow it to sell it. You don't grow it to keep it. You grow it to sell it. The world needs every bean, every kernel y'all grow. You're going to have those defensive strategies which really involve selling your production. As some of y'all say, pulling the trigger and making sales. So offensive, defensive strategies in your marketing plan. Write your marketing plan down. Know your cost of production, and know that your cash price is futures and basis and freight. So when you look at all that, I kind of come back to, and this is just Robert Harper's opinion, and I've learned this from watching a lot of you all market and listening. Sell it in small increments, sell early, and sell often. And maybe if there's anything that stands out from what I say today about basic grain marketing, it's sell in small percentages, sell early, and sell often. You are going to need to devote time every day to gathering information. And y'all have heard me say that before. I always will when I talk about basic marketing. Gather information daily. Your opinion is valid. It means something. Your opinion is good. You are an expert at this. You are the producer. And in 2020, when we live in a world that the pendulum has swung maybe too far now with information, there's so much information out there, and you have the advantage of being able to see what everybody else does. So remember that, and gather the information daily to help you develop your opinion, to be able to sell your production in small increments, sell it early, and sell it over a long period of time. And follow that marketing plan. It does take discipline. If you don't write it down, you're less likely to stick with it. One thing we've seen this year that's amazing, out of the 4,318 different things, and y'all know I'm exaggerating, but 2020 is obviously, we could all talk about that all day. We've seen a lot of things go against the grain, a lot of things that are unprecedented. The last 6 years here at Farm Bureau, anybody that I've consulted with and helped market their production, we made our highest sales of the year in May, June, and July, forward contracting our new crop and cleaning up, selling the last of our old crop. And as we went forward in the calendar year, every time we would make additional sales, we were below where we were at that seasonal high, May, June, July. This year has been the exact opposite of that. We've all stayed on with our written plans. We've stayed disciplined, selling early, selling often, and selling small chunks. But a year like 2020, instead of bringing our average down every time we make an additional sale, this year we've been bringing our average up every time we make an additional sale. So that's been exciting and positive to see, and actually new for me. I haven't had this experience before because I've only been here for 6 years. I can stop there for a second. I want to go into talking about some marketing tools, but I'm glad to take any questions on that information right there if y'all have any right now.
Anyone has any questions on what Robert's just spoke on it up to this point, you should have the ability to unmute yourselves there. So just go ahead and do that, or type it in the chat window, and we'll address those. If not, we'll move forward, Robert.
Okay. All that is pretty straightforward information, but is worthy of discussion. And if you think of something afterward, or if you're listening to this as a recording, please feel free to call me and we can discuss maybe some of the details about writing that marketing plan. And I can even show you a template, give you some ideas about that. The important thing is to write it down. All right, now when we look at basic marketing tools, if you're a grain producer, a soybean producer, and you're ready to sell your production, I break down the different sales contract types into 4 categories. The first category is called a cash contract. And when you make a cash contract sale to a buyer, you are pricing the futures, the basis, and then therefore the freight. You are locking these bushels in for a delivery period. You're locking in the futures price. You're locking in the basis. You know where the bushels are going, so you know what your freight is, and you're safe and sound. One way to think about this, when I say safe and sound, you as a producer have no downside price risk on those bushels that you sold in a cash contract. But at the same time, and you're thinking this in your mind now, that's true, Robert, but I also have no upside potential on those bushels, and that's correct. You priced them because you knew your cost of production, you worked that in with your yield, you knew where your profitability was, you knew what margin you wanted above your profit, you liked it, you sold it, you locked it in. Cash contract. That's number one. The second type of contract that almost any buyer that we work with, there's a couple that don't do basis contracts, but 8 out of 10 of them will write a basis contract for you. And when you write a basis sales contract, you are guaranteeing to a buyer a specific number of bushels for a specific delivery period, and you're locking the basis in. But there's no cash price on these bushels. So let's say I've got 10,000 bushels of corn in a bin. It's February the 15th. A end user at a feed mill calls me, a buyer at a feed mill, and says, Robert, the train hasn't come in. I'll pay you $1.20 over for your corn, $1.20 basis if you can get me 10 loads here in the next 2 weeks. You might say, I can't pass that up. However, you do not like the Chicago futures price. You're bullish. You're optimistic that it's going to go higher. You could tell that buyer, yes, sir, I'll sell you 10,000 bushels of corn, February delivery at $1.20 or whatever the basis number is, at $1.20 over the board, and I'm going to go ahead and deliver it. I can't get paid for it, but I'm going to go ahead and deliver it, and I'm going to wait to price it until a later date. That's a basis contract. And there are many, many times during the year that if the futures market is low, buyers have a difficulty buying bushels from farmers. So y'all know how they draw y'all out, how they get y'all to sell them. When the futures market is low, they raise their basis. And there's lots of opportunities during the year to do a basis contract to hit a home run on the basis part of your cash price, and then deliver the bushels, and then set your targets, put wish orders in, and wait for the futures market to hit your target. Excellent idea. So number one is a cash contract. Number two is a basis contract. And number three is a futures contract. So we've done a lot of futures contracts this year with July 21 wheat. A futures contract is when you lock in the futures part of your price on the Chicago Board of Trade, but you do not have a destination and therefore a basis or freight. You have nothing attached to this contract. It is an agreement between you and the Chicago Board of Trade where you see a futures price that you think you can be really profitable at, but you think basis is going to go higher, or especially in wheat, when you don't know what quality of wheat you're going to have until you harvest it, you might say it's too risky for me to do a cash forward contract on wheat because it might freeze on May the 10th. I might have low falling number. I might whatever, and you won't be able to fill your cash contract, but you can hedge the futures on the Chicago Board of Trade by selling a futures contract and locking that futures price in on 5,000 bushels and then waiting until you harvest the wheat in June of 2021 and selling the cash bushels to the destination of your choice that matches the quality of the product that you have. There is a little bit of a variation in a futures contract. Some of y'all have heard of this. Some of y'all participate in these. It's called a hedge to arrive contract or an HTA. That would be when you would call the destination and say, hey, I think your soybean basis for next November is going to go a lot higher than it is right now, but I want to lock the futures in. I like where November 21 soybean futures hit $10 today, and that's the truth. They hit $10 today. I want to do a hedge to arrive, freeze $10 on 5,000 bushels of beans that I'm going to deliver to you next November, but I'm not ready to set the basis on it yet because I think you're going to come way up. So that's the third type of contract. Futures contract, that's directly in a hedge account, or an HTA, or hedge to arrive, which would be doing the same thing just with the destination. 1, 2, 3, and now 4. The fourth type is what I call a minimum price contract. And a minimum price contract involves a cash sale, so a cash contract. Let's say, Robbie, you sell 10,000 bushels of corn to XYZ Elevator for December 2020 delivery. You're bullish that price is going to go higher because of Chinese demand, as well as the drought that's building in South America. So you turn around and purchase a call option, and you re-own the futures price of those 10,000 bushels that you just sold to XYZ Elevator. And that in turn makes the minimum price because you know what you sold the corn for. Let's say you sold it, picked up at your farm for $4.30 a bushel. And if you spent 20 cents on a call option, $4.30 minus 20, that means your lowest price, your minimum price is $4.10, and you've got unlimited upside potential on those bushels. That's a minimum price contract. There's a lot of ways to re-own the futures part of the cash price on bushels you've already sold with options. And there's a lot of ways to protect downside risk on bushels you have not sold with put options. Remember, call options, just like you would call somebody up on the phone, call options give you upside potential. Put options, just like you would put somebody down if you were bad mouthing them, Put options give you downside protection. Calls are upside, puts are downside, and they are used in minimum price contracts. So just again, a quick review to make sure I'm not being wishy-washy or confusing. 4 general types of sales contracts: a cash contract, a basis contract, a futures contract, and then minimum price. And I've always advocated that everybody that I get the great opportunity to talk to and work with uses at least 2 of these 4. And then when you get comfortable with that, you can move into using 3 of these 4. And then there'll be certain times where a minimum price contract will be advantageous to you. And you might even get in a situation where you're marketing your production through all 4 of these different types of sales contracts. So I think that's kind of the gist of it. I hope we can get some questions and some discussion about having that plan, writing it down, offense and defensive strategies, selling small percentages, sell early and sell often, gather information every day. Your opinion is valid, and you need that opinion to be able to know when to sell, and then be able to work with at least 2 of these 4 types of sales contracts, with the goal of at some point working with all 4 of these types of sales contracts. It is a good thing, in my opinion, to market your production through multiple people. There are also situations where people develop a really good relationship with one individual and they sell all of their production through that individual. Neither one of those scenarios is right or wrong. What you need to do is be comfortable with what you're doing, to kind of develop a cadence, a routine to what you're doing. There is great trust with you, the producer, and the people you purchase your inputs from. It's just like there's really great trust between you and who you sell your production to. That's one of the most important relationships that you have in your business. And I'm always advocating for the producer to build that relationship between them and the person they market their production to. Try to call them, or them, if you're marketing to more than one, call them often. Check in with them. Don't just call them to make a sale. Build rapport, build relationship. That comfort level is going to help you not only in understanding what you're doing, but it's going to help you in negotiating a higher basis. You're going to build that relationship, and when and if any problems come with the contract, that's going to mean the world to you, having that good relationship to work out an issue in everybody's best interest if there's an issue with the contract. So marketing can be something that's not painful for the producer. It can be something that you feel confident in. And in order to feel confident, never use hindsight in marketing. And y'all are grinning right now thinking about that, because that is hard for all of us. Know that when you make a decision with the influences that are here today, when you make a decision to make a sale, that is a good sale. It doesn't matter what happens tomorrow. We're not going to be prideful about that sale if the board falls tomorrow, and we're not going to feel beat down if the board goes up tomorrow. And that's another reason why we only make small sales and we spread them out over a long period of time in order to get that average. And I'm going to leave you with that, because that's the key here. It's not like one analyst told me one time, don't think about marketing as like trying to win a yield contest. You're not trying to sell at all of your production at the absolute high. Nobody can do that. What you're trying to do, if you take your production this year, 2020 corn, 2020 beans, 2020 wheat, it's about the average of every bushel that you sell. Not that you sold one contract down here and you've got seller's remorse. Not that you sold one way up here and you think I should have sold more. No hindsight. You guys and girls know what you're doing, and when you make a sale, it was for the right reasons, and move on to the next one. So I'll be thankful to take some questions and thankful for your attention this morning.
Thanks, Robert. Really appreciate you joining us. Excellent presentation. I think that's kind of exactly what we were looking for. So at this time, Robert, I will go ahead and open it up for questions. I see we've got one in the chat window, so I'll start by asking that one for you, Robert, and then we'll open it up for anybody that's on the line that has questions or comments. So the first question, Robert, is do all the major elevators or most of the major elevators use all four types of contracts? Do you have any answer to that? I guess the question is, are those options that you mentioned, all four of them, does it depend on who you work with, or is that pretty much standard across the board?
Cash contracts and basis contracts are very common. Almost all destinations we work with do both. We only have a few destinations that will not do basis contracts. Their accounting systems aren't set up to do that, meaning that they don't like taking delivery of a bushel of corn that they're not paying somebody for. But again, there are very few of them that will not do basis contracts. So most of them will do cash and basis. When you get into futures contracts, which with the destination, remember that would be called an HTA, a hedge to arrive. They're a little fewer and far between. And minimum price contracts where you could purchase an option, a call option, those are pretty few and far between. But those buyers are out there. And even in this environment that we've been in this year, I'll give one quick example. I tried to get a new crop 2021 basis out of a soybean exporter. And the soybean exporter said, I can't give you a basis really past January of next year. There's too many influences. We don't have any idea what's going to happen with Chinese demand and everything involved around COVID, everything involved around the presidential election. No new crop basis. So what is that? That leaves you, the producer there, going, okay, well, I like that futures price for next November, even though the market is inverted. Like I said, we hit $10 today on the November 21 soybean futures. I want that. Well, I asked an exporter, I said, would you do a hedge to arrive contract? And the exporter said, well, we don't do them, but I see what you're saying. I don't want to lose these bushels, and let me talk to my higher ups. And sure enough, a week later, they called back and said, we'll do it. We will lock in futures for you. It's going to cost a certain amount per bushel to do that, but we'll give you that advantage if you want to lock in futures and price your basis later. So just a 3-minute way of answering that question. If you are comfortable with selling to a destination and maybe they don't offer a minimum price, allowing you to buy an option, or they don't do hedge to arrive, it's worth asking them, because we even saw another destination this year who didn't allow people selling cash bushels there to re-own those with a call option, and they developed a program to do it just because we pushed them on it. Yep.
All right. Any other questions or comments for Robert? I think everyone should have the ability to unmute yourself at this time, so please feel free to fire away. Robert, we got a question in the chat. The question is, what are your thoughts on the current market environment?
Sure. Okay. Yeah, great question, and definitely on everybody's mind. One of the amazing things that we've dealt with this week, even with the current uncertainty around the presidential election, it seems like the grain and the oilseed markets have already factored in this uncertainty for president, and they're looking straight through it. We're back to supply and demand fundamentals, which has driven these futures markets much, much higher since the beginning of September. And when you look around the world right now, there are a lot of bullish signs or signs that price will go higher coming from the demand side. We have unbelievable demand for pork, for wheat, for corn, for soybeans. Coming from China is certainly at the top of the list, as they are stockpiling, and as they have rebuilt their hog herd, and they need your commodities. But when you look at the Thursday morning USDA export sales report, we've got countries on the list now that, and I've only been looking at it for 6 years, but we have countries on that Thursday morning export sales report that I've never seen on there in the last 6 years. COVID food insecurity has a lot of commercial entities in countries around the world deciding on stockpiling and buying lots of commodities. They've been incentivized to do this with the U.S. dollar futures. Y'all who've heard me speak before on the phone or in public, you've heard me talk about, grain trade is based on the U.S. dollar. And when the dollar is high, other folks, other countries' money just doesn't go as far. The U.S. dollar has fallen drastically since July of this year, and that's another story on why it's done that. But interestingly enough, it's incentivized all of these commercial entities in countries around the world and government-owned entities in a country like China to stockpile food. So the demand, if I think about current market conditions, and we have the speculator is long futures, so they're telling you the price is going to go higher and they're betting on it. When you basically have every end user, people who use what you grow, it's like they all woke up around the 1st of September. If you ran an ethanol plant, if you ran a soybean crush plant, if you ran a feed mill, whether you were in China or a country in Africa or here, you woke up sometime in early September and said, oh my goodness, I don't have coverage for my feed mill. I don't have coverage for my ethanol plant. I got to go out here and buy everything I need, and then times 2, because I think the price is going to go higher. And that's what we've seen is unprecedented demand. And if I could make another comment about how amazing 2020 is, we never lost demand like we lost it in 2020. March, April, and May, boom, everything went to zero. I mean, we had hatcheries cracking eggs. We had hog integrators aborting sows and euthanizing hogs. We had at one point, 60% of our domestic ethanol production was offline. Y'all lived through it. Y'all remember, and we list is long. And within 8 months of experiencing an insult where we lost demand like we've never seen, we're now 2 months into seeing demand come back like we've never seen. One extreme to the other, all in 1 year. And that has a very positive price outlook. Now, that's everything from the demand side. And y'all know the story. When a rally comes from demand, it goes higher and it lasts longer. That's what we have historical precedent on. Well, guess what else we've been dealing with? You can go online. We talked about gathering information. You can read about La Nina. You can look at the thermometers that are floating in the Pacific Ocean at the equator and see how cool the water is. We know we have a real La Nina event for South America and the southern plains of North America. I think some of the amazing strength yesterday, beans were up 20 cents. They're up 18 cents this morning. You got to go back to 2016 when bean futures were above $11. It's because of the drought that is building in Brazil and Argentina. It's going to impact their corn crop. It's going to impact their bean crop. And when you look at a supply side problem because of weather, at the same time that we have a demand rally because of COVID food insecurity, because of a cheap dollar, it's no telling how high these futures can go or when the managed money speculator is going to decide to get out of their bought positions. It's no telling. And I'm not making it up either. Look at the weather data from those 2 Black Sea countries that grow so much wheat, Ukraine and Romania, and obviously the granddaddy of them all, Russia. There's double the amount of wheat acres in Russia that there is in the United States. They have been so dry this fall that it's greatly impacting the amount of wheat that they can plant. And that's what's run wheat up $1.25 a bushel. So the current market outlook, there are a lot of question marks still, whether it's around what the dollar index is going to do with whoever's elected president. What is it going to look like with whoever's elected president with trade deals? How's that going to affect these outside influences we have, like the metals markets, the equity markets, the financial markets? But you're not going to get rid of this unprecedented demand that's out there. The world needs every kernel and every bean y'all can produce. And how has this trickled back? Just look at basis here in Virginia. When you talk about soybeans, and y'all know this, you're in it every day, and people who've done this for 40 years are telling me this is the highest soybean basis we've ever had at harvest time. And it seems like it goes higher every day. We have excellent corn basis bids. These folks that we sell to are wanting our production, and that's running the local market up as well as the futures market. So still lots of question marks, but an unbelievable amount of optimism in the world for prices to go higher because of that demand and the weather issue at the same time. One thing I'd say, just to wrap that up, is remember November the 10th, next Tuesday, we get the November USDA supply and demand report. There are going to be a lot of eyes on that. They're going to be looking to see about carryout, how many bushels are going to be left over on August 31st, 2021, at the end of our marketing year for corn and beans. The numbers are going to go lower. They're going to be looking for North American yield. Is USDA going to adjust the yield down next week? Our production down next week? So a lot of volatility on Tuesday at noon when that report gets released. So that's something you can be focused on right now and looking forward to.
Any further questions for Robert this morning? Robert, I'm just checking the chat window. I don't see anything additional there. So we just give folks a few more seconds if anybody has any questions or comments before we finish up.
Hey, Robert.
Yes, sir,
Yeah.
Mike.
I got a question for Robert.
Go ahead.
Robert, can you hear me?
Yeah, I got you, Mike. Yes, sir.
Robert, are we still actively trading with China right now? The reason I asked, they're going through a terribly wet year. And I've been watching this thing called the Three Gorges Dam. It's one of the largest dams in the world, hydroelectric dams, and they're thinking it's cracking and getting ready to break. What is that doing to the demand side of grains, especially soybeans, if anything?
Yeah, we're definitely actively trading with China right now. There's a lot of vessels that are getting loaded, going overseas from East Coast ports like Chesapeake and like Wilmington, the Gulf Coast, the West Coast, Pacific Northwest, Great Lakes. It's lots of production headed that way. We went through about 2.5 years of their hog herd being downside from the African swine fever. We're all familiar with that, what they went through, how they controlled it. We're coming into a year now of them growing their hog herd. So they need more commodities in order to feed all of those hogs. And they really ramped up from the government data you can read and private industry data during those 2 years that the hog production was off. They ramped up their poultry production. And it seems like so far that poultry production is going to stay at the high level that it was at when the hogs were off. So there's a big need over there. Now backing up some of these weather issues that you're talking about, Mike, I've heard a little bit about the threat of this dam. I don't think I'm as educated about that situation as you are. I've read some about it, but one thing they did deal with significant crop problems in their growing season this year think about this, and I'm talking real generally. China, it's hard for us to believe, but they're the #2 corn producer in the world, right behind the United States, then Brazil. They had some issues over there in their growing season, but think about China normally being able to grow the majority of corn that it needs. They're almost, this is how I interpret the numbers. They're almost self-sufficient when God makes it rain over there on their corn production. They are nowhere near self-sufficient on their soybean production. So they have to look to South America and North America to purchase that, to fill that void in their soybean production. And that's going to continue. You know, the big issue has been the last 30 years, how much investment they've put into multiple countries in South America to ramp up their soybean production. We know their #1 go-to on beans now is Brazil and not us. We're riding shotgun, so to speak, now. But still, they need so many beans because their domestic ag system pretty much self-sufficient on corn, but not on soybeans. So they're going to keep buying from us. I guess the word I would use is out of necessity. Is they had some crop problems there this summer. Their corn production is off. And remember, it's hard to, and y'all know this, I'm just talking out loud, it's hard to interpret government numbers that come out of China. And that's another discussion, but you're always kind of in the gray area trying to figure out how much corn they have in reserve, and are they saying that number accurately, or are they misleading with that number to keep global prices low? And again, that's another discussion, but they're going to keep buying from us for sure. And not just because they want to meet the phase 1 trade deal that they signed on January 15th, but they're incentivized to meet it because the dollar value is so low compared to where it was Trump's first 3 years as president, and their money's going a lot farther, and they're incentivized to buy it because they actually do need it. And then if you throw this wild card, black swan, whatever you want to call it in there, if this La Nina really sets in, and say Brazil, Argentina, Paraguay, and Uruguay grow 3/4 of a soybean crop because of a drought down there, they're going to be coming back to the United States sooner, and they're going to be buying more beans from us. So it seems like a long-term trend right now, even though we're only a few months into this kind of buying. And that's what one of those many question marks is, back to this presidential election and who's going to be president and how are they going to deal with China.
Thank you.
Yes, sir. Did that answer what you were asking?
Pretty much, it did.
I get to rambling on. I need to look up. You and some other people have been talking to me about this situation with that dam over there, and that's a good reminder to me I'm gonna dig into that a little bit, see what I can learn.
All right. Any final questions or comments for Robert this morning? We're wrapping up just about 9:45. So anybody that has a question or comment, we'll go ahead and take those and wrap up this morning. Now, not hearing any, Robert, I'll go ahead with some closing comments. First of all, just like to thank Robert, as always, this morning for joining us. Really appreciate your efforts, Robert, all the great information. And this, as you said, is going to be recorded, so folks will have the option to view this later. So if you or anyone else on the call with us this morning is interested or know someone else that may be interested in this, please send them to the recording. You can see that link there posted on your screen now. Also, please feel free to contact any of the agents that work with this effort. We'd be glad to get you the links for all VC Ag Today session recordings. So thank you, Robert, for joining us this morning.
Yes, sir. Also, you're welcome.
Thanks, Robert. Also, I would like to thank the other VC agents that helped make this effort possible. Mike Broadus, Stephanie Rommelchek, Laura Maxey-Nay, Trent Jones, and of course myself here in Essex, Robbie Longest. But just thank you to everyone for all your efforts to make this possible. And then two last comments. First of all, next Thursday, we're going to be joined by Dr. Michael Flesner, our extension weed scientist. He's going to be joining us and talking about a lot of the over-the-top dicamba product updates for the herbicides. Many of you probably have seen that in the news here very recently with the EPA renewing some of those product registrations. So he's going to be with us to share a lot of updates and information on that. So please join us for that. And same time, same place next Thursday morning. And finally, if you've been with us this morning or with us in the past, please take just a few moments to complete our evaluation. You'll find the link in the chat window. Stephanie has posted that there. It's the last comment in the chat window. If you click on that link directly, it'll take you to our evaluation. And if you have questions, comments, or just topics that you'd like to see featured in the future, please let us know and we'll be glad to do that. So once again, thank you, everyone. Robert, thank you again, as always, for your time. We always appreciate the opportunity to have you join us. And hope everyone enjoys a great rest of their Thursday and has a great and safe harvest season as we continue forward.